little bit of time to gather some information because we're working on some legislation, but I just wanted to introduce myself a little bit. My name is Roza Calderon, and I'm a geographer, and most of my work is mostly in GIS and geospatial sciences. So my work has been in the energy and environmental industry, and in that sector we have been able to do some fire hazard models, vegetation management, inventory, really anything that has to do with California and the wildfire risk here. So we collect the data either on foot, driving in a car, ATV, and if we're lucky enough, we go on a helicopter and do LiDAR and remote sensing from there. So that's pretty exciting. But on the other side of that, I'm also politically involved. So when I found out about what's happening right now, besides that, I've been involved probably since I was a teenager. My daughter's 14, probably around that same time. And I essentially got involved to advocate for issues that had to do with education and healthcare and the environment. And that's one of the reasons why we're working on this right now. So this doesn't have to do exactly with the process, but it has to do with data and the way the data is being managed by certain companies. So I wanted to talk a little bit about wildfire risk models in California. And this is essentially a case for regulation for wildfire risk data, and it's essentially and hopefully a consumer protection. So as you all know, the 2018 California wildfire season was a record-breaking season. It was the most deadliest, the most destructive, and the largest by area, burning 1.8 million acres. And it was the biggest fire season that California has ever seen before since recorded history. We were able to also break 3 records that I don't think anybody is really proud of, which is the Car Fire was the most destructive fire. The Mendocino Complex Fire was the largest by area and burned almost 500,000 acres. And the Cat Fire, unfortunately, was the deadliest fire with 86 casualties. And there's a few reasons why this is happening right now, and of course one of them is climate change, the other one is the drought, the other one is the bark beetle infestation, and overgrowth within our areas right now. But wildfire risk in California is expected to get worse. Fires will get bigger, they will get more intense and more damaging. Right now, 30% of Californians live in wildland urban interface zones, WUIs, and just to gauge, that's about 11.2 million people who live in these areas. 2.7 million live in high fire hazard zones, which is the most intense regions. And one of the ugly patterns and unfortunate patterns that we've seen right now is that we've seen an increase of 41% of housing construction in these zones. So these are your mini mansions that are being built in the hills. Between 2017 and 2018, insurers paid out about $24 billion in claims. And since 2015, insurance companies have declined 350,000 policies for renewal because they live in these high-risk areas. The people who have been the hardest hit live in rural regions, mostly low income or fixed income. And as you can see there is a little bit of a pattern, but not precisely. It really has to do with the fire season the year prior. And as you can also tell, we only have data from 2015 to 2018. And for that reason, the reason for that is because we don't have control over the data. The data on property insurance has only been collected since 2015, since there was a request by the state. But insurers are not required by any law to actually provide any information or any statistics. So the California Department of Insurance has no legal authority to regulate or to see how they are going through the process of underwriting policies for residential property insurance. The data that they have submitted shows that more non-renewals were initiated by the policyholders versus the insurance departments. But again, one of those things that we have no control in getting is the data that tells us why they didn't renew, and the insurance companies claim that they don't have it. So since 2017, the rates have increased statewide about 50%, but in some extreme cases, you can see policy renewals going up for like 600%. So somebody that could have been paying, $2,000 a year can be getting quotes between $7,000 to $10,000, and that's just not feasible for many people. And so what's happening is, since they're getting kicked off of these insurance policies, they are looking for anything else that they can go on to, because as you saw in the previous graph, there are payouts for insured homes and there's uninsured homes as well. And the FAIR plan is a shared market plan with its part of California, but there is no funding for it from the state. It is meant to be the last resort, meaning that this is the last option for many people who live in WI high-risk zones. And insurers usually wait until the policy is about to expire to send you a cancellation notice. The Department of Insurance, as you'll know, they have a stronghold within our government, so they were able to get, 65 of the largest companies were able to get increases pushed through the state, so they passed on the cost to the consumers. So the $1.17 that they were paying over the $1 was passed on to the consumers, and they were still able to profit from that. And including like big names like State Farm, Travelers, and Nationwide. Just last year in 2018, 21,848 Californians bought the FAIR plan, meaning that they had no other option for home insurance. And because of the new push to get this insurance, they imposed a 20% rate hike. So it really didn't help too much. So one of the issues that we're having with the fact that we don't have the data that these insurance companies are using to create their risk assessments and the scores that they give individual homes and regions to charge these rates, is that the wildfire risk models are not regulated by the CDI, by the Insurance Department of California. They are basically completely autonomous, and they can do essentially what they like. They can hire a third-party company to come and do the assessments, and they apply the scores at free will, essentially. So insurers are pushing even further, so they don't want to just use the regular risk models that they've been using. They want to use catastrophic models so that they can charge you even more. And they're looking at the risk, they're looking at different things, because previously insurance companies were based off statistics, but now they're using your user data. I mean, your social media, anything that they can use to quantify how much of a risk you pose for them. And the problem with that is because the models are opaque, they fail to adequately and fairly capture wildfire risk. Insurers also, they don't include any wildfire mitigation efforts by the homeowners or the business owners or the community. So even if you've done everything that you can do to mitigate and have your area cleared, they don't consider that into your policy, and they also don't provide any mitigation effort credits. So what can we do? The Commission on Catastrophic Wildfire Costs and Recovery came to the conclusion that we have to do something immediately. And it says the Californians in the wildland-urban interface contribute to the economic and cultural vitality of the state and deserve adequate protection from wildfires. It is critical that not only utilities, but also homeowners, renters, federal, state, and local governments, and others act to reduce the risk of wildfires in the WI. We must not incentivize risky behavior, including the risks many Californians take by continuing to move into the most fire-prone areas. And there have been some legislative efforts to protect Californians and consumers. So some of them have been successful and some of them have not been successful at all. And one of the ones that was successful last year was to make sure that it prevented insurers from canceling your insurance policy up to 1 year after a natural disaster. So what they were doing was, like, if there was a fire near your area or in your area, they could cancel your policy at any moment before you even filed for your claim. Yeah. So the first buffer was 30 days, and then now we pushed it to 1 year, because when you lose everything, I think the last thing people are thinking is, how am I going to itemize everything to get my money back or rebuild? So that one was passed, but it wasn't the first time that they were trying to push it through, but by the third time it was a charm. And then the next one, SB 897, it allowed for additional living expenses, but only if you have a total loss. So if you have a total loss, they wanted them to give you 4 months up front, or at least 25% of the money that you were going to get in your claim, so that you could use that money to either purchase a new home or to start renting someplace, because these people were essentially living in FEMA trailers. And that one was killed in the Senate, so it never went through. And we have other issues with insurance adjusters that come out and do assessments, essentially, that will benefit the insurance company, and they deny claims. And that one was held in suspense, so it never made it past the Senate. It's just sitting there. It's probably not going to go anywhere. And then fire insurance, because every policy almost forces every consumer to negotiate with them before you can file a lawsuit. And that could be through their own negligence or through their person who was selling you the insurance didn't explain the policy to you correctly. And that one actually did pass. So it gives the consumer 12 months to 2 years to sue the insurance company for misrepresenting the insurance policy that you were going to be in. And the last one is the one that we have going right now, which is a special fund. So one of the things that same commission recommended was that we establish a fund allowing the governor essentially to buy related alternative risk transfer products for the state of California, so that we had the funding to help out and mitigate costs for mudslides, fires, and floods. And the group that I'm working with is the Rural Caucus for the California Democratic Party. And through the recommendations of that same commission, we were able to, I wrote this legislation, but we have 2 senators who are going to introduce it to the floor. But the things that we're asking is to implement this California Citizens Insurance Fund. And it's modeled after the Florida Citizens Insurance Fund that they put together, because they were going through the same thing because of the hurricanes in that area. But the things that we're asking for is, number one, is the creation of a publicly owned, nonprofit property and casualty insurance company that is competitive enough to compete in the market. And then the second thing is ensure legislative authority for the California Department of Insurance to regulate and oversee how insurers overwrite or underwrite residential property insurance. And the third is to reestablish the rating structure to ensure that homeowners' insurance rates and premiums are stable and adequate and reflect true wildfire risk. And the way that we're going to do that is by having one single wildfire risk model that is going to be created by another commission through CAL FIRE. And it will be the standard model, which all insurers will have to kind of use as a standard. And any other, for their ratings and underwriting, and any other third party that has created their own models would have to get approved by the state as a regulation, just to make sure that nobody's getting kind of these. And the last thing, of course, we want to make sure that we stabilize the prices of home insurance right now, which would be to take away the for-profit model. And that would make us do, it would adjust all the rates so the insurers pay the same rate for every thousands of dollars of value. And that was the original insurance structure before the for-profit model was introduced, and that would stabilize the market value. And that's it.
That Florida legislation
taking a lot of lessons from their mistakes. One of the things that they had issues with initially was they didn't implement a tax that would cover that, and so they did it through a bond initially. So the bond itself wasn't enough to cover the risk of all the assets that they were holding. And I think initially they had like $500 billion, but they didn't have enough money to actually fund anything if there was a natural disaster that would do all of that. But so far it's been working great. So they have reduced the risk so much by doing other mitigation issues or mitigation things that they have. The market for insurance has actually flourished in the area.
The wildfire that was in Paradise not too long ago, we had the smoke and ash came to Sacramento, so it was like a big deal. You know, I know a lot of those people lost their houses and stuff like that for their insurance. Did all those people like just lose everything?
Yeah, so most of those houses were total losses. And another great example of that happened here in Calderon County, where there were total losses as well. So it opened up the market for people who, okay, so here's what the insurance companies do. If you have an insurance policy and there's a fire that comes through and your house is a total loss, they can find really any tiny little thing to make your claim invalid, which means like if you were, you know, redoing your deck, but you'd never notified them of it, then they would say that that was probably what caused this fire and caused a total loss. So people were not able to pull their claims, so everybody was kind of just selling their land like pennies on the dollar and moving out of there. And most of those regions they're still uninsurable, or their rates have gone, they've skyrocketed.
One insurance company filed bankruptcy right there, right, in Paradise?
One did, but it was a smaller one in the Central Valley.
Yeah.
And it didn't have the cash on hand, essentially, supposedly to cover the insurance policies, but it still was able to pay out for any stockholders and their bonuses. So.
The bill that you wrote, what stage of the process is it in right now?
It is still in the proposal process. So
okay.
What we did was seek at least one senator or assembly member who would introduce it on the floor. And luckily there's a lot of fires, I guess, in this area, so there's a lot of interest in it. So we were able to get two senators to come forward. One of them is Senator McGuire, who covers the Humboldt area on the coast, and then we have another one down in the Central Valley as well. Yes, yeah.
So I love your proposal. I think it sounds awesome. I love the nonprofit format. If somebody wanted to assist with it, like how could we help?
Oh, yeah, that would be amazing. If you can help, I can give Janessa my contact information, and I don't mind if you share it with everybody, because we need as much help as we can get so that we can analyze the little bit of data that we do have to create our own risk analysis, because the work that I've done has been through private industries, so it's not my data to use unless I can get it from the state, and I do have all the state data. It's just not enough.
What incentive would there be for private insurance to get into the market if the rate is already being determined by your risk assessments?
So the risk assessments, they don't actually reduce the amount of profit that you can charge, but what they're doing is making sure, like here in the Sacramento area, like where we are right now, they can give you a score for high risk area, but really you're not a high risk area. You might be like a moderate level, but the insurance company won't ever tell you that. They just assign you a score, and what they also do, especially now that they're really meshing into the big data analytics field, is that they're using other risk factors too, like the cars that you drive. They're using data from your car insurance. They're using data from any way that they can to hike up those prices. So there's not an exact model for each insurance company, and there is no way for the state of California to regulate what they're doing for their models.
Like how many insurance companies, like let's say I live, I don't know, in the hills somewhere, like how many options would I have? That's
the other thing. So we have a monopoly of insurance policies that are available. And the other insurance is like what is it called? It's like a secondary insurance to take higher risk. So some insurance
Reinsurance.
policies- What is it?
Reinsurance.
Yes. So if you have, like, let's say nationwide and they cover like $500,000, but your home is valued at $1 million, that's one of the other things that we want to make sure is that market value matches the coverage, so that in the case of a fire, when your home is valued at $1 million, we'll be able to cover it if in the case of a total loss. So, but those companies right now, they're all, they're not struggling, but they are thriving. Like, they're definitely not in any position right now to file bankruptcy. And one of the reasons for that is that we just saw that PG&E shut off the power to almost 2 million homes. And the reason they did that is, whether they like to admit it or not, it has to do with liability. Because the state of California, the laws, they essentially apply liability to the electrical company if their equipment was at fault for the fire, regardless if it was negligent or not. But if it was found to be negligent, what the insurance companies can do is they can come back and sue PG&E, for example, to get all that money back and they pay it out of claims. So that's one of the reasons why insurance companies are still thriving versus somebody like PG&E who's looking to file for bankruptcy.
Yeah, I guess like the question I'm asking is, if there's only a few options, maybe they can kind of like all evaluate, raise the rates together. But if there's a lot of options, then the market should kind of, you know.
Yeah, but they're all kind of raising their rates together. So, for example, a friend of mine just, he got a quote for $11,000 initially, but was able to get the lower end was $6,900. And he lives in Angels Camp, kind of in the Sierra Nevada area. But before he was paying $2,800. So it's like a $4,100 difference. And so the most competitive one was still exploiting the price market.
Is there any, I guess they're all using their own closed model for risk. Is there any evidence or knowledge whether they share that model amongst themselves? Are they doing any, do they use third parties to develop their models?
I did research that, but I couldn't really find any of the risk models that were public or any articles that talked about one specific model. But there are some companies that are the giants essentially for models, and I think one of them was RMS, which they do all sorts of different modeling for natural disasters nationwide. And one of the things that they have marketed is the catastrophe modeling that they do to assess risk for insurance companies now with all the wildfires that are happening. So they're really zoning in on just the wildfires right now, and they're making tons of money off of it. Any questions? That's it. Okay. Well, thank you.